Welcome to the daily stock review of Taiwan Semiconductor. The goal of this channel is to uncover the world's best stocks that have 100x potential. I'm an individual investor, about 2,500 hours in, over 7 years, and I'm sharing the lessons along the way. We're going to go through the stock analysis first, go through YouTube comment questions and answers, and then review goals. My investing process is 5 steps. Today we'll go over where to look and where I found this stock, and the 5-minute check that will simplify what we need to do to decide if we need to look at this business further. I learned off these guys. They've done pretty well for themselves over many decades, and so by following in their footsteps, hopefully achieve some of that success as well. All right, well, let's crack in. What I'm first going to do is go and find the annual report. So I literally just typed in Taiwan Semiconductor annual report, and I can see that we've got a couple options. There's an investor page or straight in the PDF. I'll just jump straight into the website first of all. So where did I find this stock? While looking around at just global issues, so like in the news and things like that, and looking at conflicts between, I guess, the US and China and things like that, and the whole Taiwan taking over, that pretty much is where I came across this stuff, because a very large proportion of the chips that are in a lot of our items of technology, including like iPhones and things like that, and ones for our cars, all pretty much, or majority of them, come from Taiwan. And so that's where I came across the stock. Now we've got options. It's really good to see when a business has got all their reports historically. So that's good to see. We can go through quarterly results, but let's just go through the annual report to see if it's worth looking at further. I do want the PDF. Let me just see. Let's see if we go through the Form 20, because I do like the format of the US style one, because it gets rid of a lot of the non-essential media and things like that. And what I'm looking for, first of all, is financial statements, because we do want to have a sticky beak through those. We've got a auditor report and sign off, and here we go. So what do we got here? I want to have a look at the income statement first, because that's my habit and I like doing it. So what have we got? It says in millions of new Taiwan dollars or US dollars, except earnings per share. Okay. So where we got? So we've got a comparison of new Taiwan dollars, and then we've got the current year, so 2025's conversion to USD. So let's just we'll have a look at these for trends, and then we'll have a look at what that actually means in US dollars. It's a bit more of an easier comparison. So net revenue is trending up a lot. So it looks like it's 50%, and then pretty much another 50% growth in net revenue. And what's that up to? That's up to 121 billion, because that's in millions of, or US dollars, or 121 million. Let's just go through. All right. Comparison though, then we've got cost of revenue 48, so a lot less. Gross profit, that's very healthy. This amount compared to what it gets in. Research and development, general admin. So we can see that these research and development has been increasing. So I know that this company makes and builds the semiconductors and things like that, and other pieces of hardware. So we'd expect research and development to be part of maintaining that competitive position, as well as investing in the infrastructure. So that's good to see. It's maintaining its moat around the business. And we also want to see what that looks like as we go through these financials. What about net income at the end of the day? So we've got a couple other bits and pieces that come out. You can see net income, it's increasing, and yeah, about 50% year on year. A little bit less for this back here. And then at the end of the day, compared to the 121, we've got 54. So that's around 40% net income at the end of the day compared to, I guess, the net revenue. And that's huge. That's really good. What else we got? So the balance sheet was actually up here, and in this document, it's also known as the statement of financial position, because I guess it shows them how they're currently sitting. We've got our assets first. Let's just have a look at total current assets. So current assets has increased, and total non-current assets has increased as well. Property, plant, and equipment is our main one here. And we can see that that's been increasing. And if we're looking into the business further, we'd want to have a read of these notes. And they're the part of the notes to the financial statements. It gives us a little bit more information about what's in this number and any other discussion that the management team have decided to put in. The liabilities, let's have a quick look at those. So 48, a lot less than the total current assets, which is just, current just means things that can be liquidated, or assets is things that can be liquidated in the next 12 months. Current liabilities is things that need to be paid within the next 12 months. So you can see that they've got enough cash to sort that out. Total liabilities, super small compared to the non-current or total assets, which is great to see. All right, let's go and have a look at the cash flow statement. And really, I'm trying to assess whether the management team, where are they deciding to spend the company's money? So the three things I'm really looking for just to answer here is mastery. Has it mastered its customer? It's got revenues, huge revenues that are increasing around 50% year on year. So I'd say, yeah, they've got pretty good product market fit. The other one is the moat of the business. Does it have a strong competitive advantage and it's able to have pricing power? I'd say yes. With 40% net margins, that's a pretty good indication that they do have a lot of pricing power. And the other one is management. So we just want to assess if management's spending the money where we think they should be, and they're not just blowing all this extra cash that the business is generating on things that are worthless. So let's have a look. The money that comes out of here at the end of the day is usually some non-cash charges. So things that don't actually affect, I guess, the bottom line of the business, but it's part of accounting for it. Finance costs, share profits of associates, interest income, share-based compensation. So that's fairly minimal, which is good to see. Loss on disposal or retirement of property, plant, and equipment, loss gain. Some minor entries there. So changes in operating assets and liabilities. So I was looking around for just the sum, cash generated from operations. There we go. So this number here should be this number with all these adjustments. This is our operational lines. And then it comes down to where it says changes in operating assets and liabilities. So it's, oh, sorry, take that back. This goes on and on. So they have a lot of line items here. So usually these are confined just to one page, but they've gone and broken up a lot more items, which is good to see. It's a lot more transparent and makes it easier to analyze these statements. So it actually comes down here. It's just cash generated from operations is 81. Net cash generated by operating activities, 72. So this is the number that I'd like to use, and I want to have a look for property, plant, and equipment, because if we get that number and subtract this one, which is 40, that gets us to 40. We know that effectively that 40 is the net margin, or was the net profit of the business pretty much, and it's pretty much able to make that much cash each year and plow that. This 40 needs to go back into maintaining its competitive position. So it's got to buy equipment, other bits and pieces like that, to be able to look after the equipment it already has, to manufacture and sell those items. So you can see that property, plant, and equipment hasn't been going up a lot. Like, it's not in lockstep with the amount that it has gone up in revenue, which is good to see in terms of per unit volume, that they can produce more and more from what they already have. So this business can make about, what, depending on if that was in US, I'd have to check, but 40 million straight up in cash that it can just straight away do what it likes with. So this is a pretty healthy business, and I'd say, where is anything else in particular that looks out of place? Cash from financing, hedging financial liabilities, proceeds, repayments of bonds, proceeds from long-term banks, payment of transactions, cash dividends are up. Disposal of ownership interests, interest in donation of shares. All right. So looking through here, they've provided what has the management team done with it? It doesn't look like they've done anything out of the ordinary in here. They haven't had a lot of debt or anything like that to try and look after. They've provided a dividend to shareholders, and then they've kept some of that money within the business. So we can see cash equivalents at the start of the year was 67, and it's gone up the remaining amount to 88. So fairly reasonable. What they're going to do with that money, we would want to read through the rest of the report and see what are the long-term goals for this business in terms of, are they going to build another factory? Where are they going to put it? Does it have the risks of, like micro and global effects? Say if China is going to try and invade, what will that or even if it starts more of a process around it and performs a blockade, like what does that do short, medium, and long term to that business and the effect around the globe, and things like that. So this one's got a lot more bits and pieces around it, which make it a little bit more difficult to analyze in terms of that global landscape, but it makes it a very interesting company. So let's just see how it's gone in terms of its share price, considering that it has increased 50% over the last few years. And can see that going back to July 2021, sure enough, it's gone up and continued by around 5x. And it's definitely being recognized by the marketplace in terms of the price people are willing to pay for it. And it's probably justified. Let's see the PE ratio. Just a quick look at what's the price compared to its earnings, and remembering that its earnings were fairly high. And so we've got a market cap. Whoa. So we've got a PE ratio of 26, and I guess that's fairly reasonable. I will decide to look into this company further. It's definitely got a pretty reasonable investment thesis to go and have a look at. And so I'll be adding it and doing a deep dive, which the next step on the process was going to be going and do the homework and then performing a valuation on it, and then finally looking at what that means if we were to add it to a portfolio, decisions around that. So let's crack over and open up some YouTube comments, questions and answers. So this is our first review. So one from Lee Laffin. I'm very long at Duro. By the way, my name is Lee Laffin. Nice to meet you, Jack Laffin. Thank you, Lee. Nice to meet you as well. Hewlin Bryant. I'm long Duro, analysing pre-revenue company developing a new technology with a dozen new patents strictly off financials. It doesn't make much sense. Since they joined NASDAQ on November 7th, 2024, the stock value is up 230%. And I'll take that dilution any day. So I guess a couple of points from me. When a business is pre-revenue, it's definitely the more higher risk point to get into that stock. And there are a number of companies, and I guess it's the survivorship bias. So there's many companies that have done exactly what a Duro is doing currently, and then brought those patents to market and then realized that there isn't a market for it. They're a lot less successful than they are, and they aren't actually able to make a profit. And then those patents sit there on their balance sheet, not able to actually make any income. And so what does that business do long term? It just continues to do that. So if you'd like to check out a video on my other channel, it actually breaks down one of these examples of a company that's been doing it for over 20 years. And around every 5 years, they change name and continue to do the same thing. All they do every year, they don't actually go bankrupt and out of business, but they continue to bring new shares to market, and the stock price has gone from pretty much down to 99% loss, compared to when one of our members in one of the communities bought into it back in 2007. So there are examples of companies that are wonderful that do get through it, but there's just a lot of things that need to go right for a Duro. And that includes getting those patents, building the technology, making it commercially viable at the end of the day, and then actually being able to make those products and services, and then actually having customers. So if you look at the big long list of things a company needs to do in order to be successful, Adura has a very long list of things that they need to prove that they can do before this company actually makes money. And with that money that you've currently got locked away in it, yeah, sure, the stock price may be going up and down in value. And I use the term value loosely. It's actually just the price people are willing to pay for it at the moment, because that company doesn't have any or doesn't have much intrinsic value because it's not making a profit at this stage. Now, is it worth looking at? Yeah, definitely. It's just one of those ones where on the continuum between what is a speculation and then what is a investment is just one end of the spectrum. And so it might be that you guys get very long in it, but you're not betting 100% of your investment for the future on this company. It's one of bits and pieces that'll fit into your investment portfolio. And it's just important to remember whereabouts and what percentage you're comfortable with putting behind it. And that's all. So yeah, there's always things that can go wrong, will go wrong, and things that just some things perfectly go right. But at this stage for me, it's just not worth looking at because in the future they may get to profitability and there'd be another entry point. All right, and another one from Lee Laffin. I'm also Canadian. The Canadian dollars are just dollars, but we call our ones and twos loonies and toonies. Nice. Yeah, I did ask during that video, Australian dollars get ripped off and called dollary doos. Thanks, Simpsons, for that one. I just didn't know what they called the Canadian dollars. With the US of A right next door, I thought we'd have a much more humorous ripping each other off with some banter between the boys. All right. And some goals of the channel. So each day I go through, and here we are from this week. I've been doing 3 reviews each day. Today, I've only got the 1 at the moment, but that'll be getting up to 3. This is the first for the day. I haven't added any to the watch list yet. I've got a number that need to go back through the deep dives. Channel subs, we are sitting at 3. Yeah, boy. And the investing group and community with the free content is sitting at 31. So look at that. That's over 100% growth in less than a week. That's how you do it, guys. Now, will we be able to maintain that growth rate? Probably not. I'm anticipating it'll be slow growth for a while, and slow and steady wins the race with these ones. If you guys like this content and you want to see how I do my investing process or other stocks that I review, jump on and subscribe. Leave a comment if you've got any, especially about Taiwan Semiconductor. Leave it on the latest vid. And if there's any other stocks that you guys are looking at that you'd like reviewed or that you think are great investments and things like that, or just great speculations, like chuck it in the comments. Let me know what you're thinking and what kind of weight you're putting behind it, and we'll go from there. Otherwise, check out this next video because YouTube reckons you'll like it. Cheers.